Ladies and gentlemen, good day and welcome to Cholamandalam Finance Holding Q4 and FY2024 earning conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Parth Jariwala from DAM Capital Advisors. Thank you and over to you, sir.
Good morning, everyone, and welcome to Q4 FY24 earnings call of Cholamandalam Financial Holdings Limited. From the management side, we have Mr. Sridharan Rangarajan, Non-Executive Director, Cholamandalam Financial Holdings Limited. Mr. N. Ganesh, Manager and Chief Financial Officer of Cholamandalam Financial Holdings. Mr. V. Suryanarayan, Managing Director, Cholamandalam MS General Insurance. Mr. S. Venugopalan, Chief Financial Officer, Cholamandalam MS General Insurance. I'll now hand over the call to management to discuss the FY24 earnings call and give their post which we can open for question and answer.
Right.
Over to you, sir.
Sure. Thank you. Good morning, and hope all of you are doing well and your family is in good health. I have pleasure to talk to you in the Q4 earnings call. Both the companies, MS as well as Cholamandalam Finance, have done exceedingly well. Today I have with me Mr. Suryanarayan, MD of Chola MS General Insurance, and Mr. Venugopalan, CFO for Chola MS General Insurance, and our CFO, Mr. Ganesh. So, since there is a wide coverage as far as Cholamandalam Investment and Finance Company, you would have already attended the calls as well. We will clearly focus this call to Chola MS General Insurance, and I request Suryanarayan to give you the opening commentary about the business, and then we'll open up for the Q&A. Thank you.
Thank you, Sridhar. Good morning to all of you for joining the call. And I shall now proceed to give an overview of performance of Chola MS General for the quarter and the year. In quarter 4, Chola MS recorded a gross direct premium of rupees 2,007 crores with a growth rate of 13.6% as against the multi-line insurers growth of 10.9%. The full year premium was at 7,533 crores. With a growth rate of 22.4% as against the multi-line insurers growth of 14.2%. The company has grown across all its channels. For the quarter ended March, in its captive channels, business from the sister company and the Insurance Express outlets, GWP grew by about 21.5% apart from growth in other channels. In the financial year, Chola MS recorded a crop insurance premium of rupees 465 crores, which constitutes about 6.2% of the top line. With growth in commercial and hat lines, the composition of motor in the overall premium has reduced to 65.9% from 70.6% in the previous year. In motor insurance, with a gross premium of rupees 4,964 crores for the year, Chola MS is getting stronger in the private car segments across both new and used vehicles. The company underwrote over 100,000 electric vehicles in the year across categories. The company, excluding crop, has 26.5% of its premium from rural markets. The expense of management for Chola MS for the year was at 32.64% as against 35.79% in the previous year, a reduction of 3.15%. The claims ratio for the year was 73.7% against 71.2% in the previous year. The impact of the natural catastrophic events for the year in value terms was about rupees 55 crores, which rendered the overall claims ratio higher by 1.08%. Besides, the NatCat claims also impacted the reinsurance commission earnings. The company continues to be prudent in its reserving for motor third-party claims. The combined ratio for the year was at 109.9, which includes the impact of 1.08 by way of NatCat events. The investment portfolio corpus as at the end of the year was at 16,501 crores with an investment income of rupees 1,116 crores. With no exposure to stressed assets, recoveries from the fully provided exposures in Reliance Capital ILFS would be recognized on cash basis as and when it happens. The profit before tax in quarter 4 was 91 crores and for the full year was at 444 crores as against 264 crores in the corresponding period. The return on equity for the year progressed to 14.25% as against 9.64 in the previous year. The company during the quarter was acknowledged as the best mid-sized non-life insurer by Mint publication. We'll now be happy to take any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Atul Mehra from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi, good morning and thanks for the opportunity. Sir, recently there was this SEBI discussion paper around investment holding companies where they're talking about a proposed call option mechanism for more appropriate price discovery. So is the board or the management...
You are not audible, sir. Could you please...
Yeah, I'll just repeat.
Yeah, that's better. Yeah. That's better now, yeah.
Yeah. So basically I was saying that recently there was a SEBI discussion paper around investment holding companies for better price discovery of investment holding companies. They are proposing perhaps a call option mechanism and so on and so forth. So I just want to check, is the board or the management doing anything in terms of to make sure that there is better in terms of underlying value created for the entity, which is Chola Financial Holdings, and there's a better price discovery that is coming about. So any comments or anything that you can talk about either on behalf of the board or the management?
Sorry, honestly, your line is not that audible, but I think I guessed your question and probably answered. In case this is not, then please let me know. So as Cholamandalam Financial Holding, probably you are looking at an option for it, the underlying subsidiary to be listed, or potential value creation is probably the underlying question that you're looking for. Is that correct?
Yes, sir.
Right. So I think we have been telling all the while is that we feel that at an appropriate time, either when the statute forces us or at an appropriate time, we will be more than happy to look at this. But for the capital required for the insurance business, both the partners are committed to provide and we continue to support that initiative. That is a position that we are holding from the beginning, and we will continue to hold this.
Right. But is there any timeline to it, sir?
No timeline as such.
Right. All right. Thank you, sir. Thank you.
Thank you. Next question is from the line of Sanket Goda from Avendus Spark. Please go ahead.
Yeah, thank you. Thank you for the opportunity. Sir, I just want to understand your growth strategy for next year. For the current year, we did crop 470 odd crores, but we naturally slowed down a bit in motor in the current year, especially in the second half of the year. So just wanted to how you will look at growth next year, which line segments you will grow, whether we can see a growth in crop to grow better than 470 crores what you have done in the current year, and any revisiting of your strategy with respect to commercial lines, especially fire marine, given we are largely limited to our JV partner exposures there, not begin other than the banker relationships. So just wanted to understand what is your growth aspiration next year, and which products will drive the growth, especially motor, crop, and commercial lines. That's my first question, sir.
Thanks, Sanket. All of you are perhaps aware that the last 2 years, Chola MS has been growing faster than the industry. 27.2% in 22-23 and now 22.4% in 23-24. So the company is committed to growing higher than the industry growth, multi-line players growth for 24-25 as well. And then, so to talk about crop, last year marked a re-entry into the crop segment where we had a cluster in Maharashtra which gave us about 465 crores. The company will continue to pursue opportunities in the other states. In fact, Tamil Nadu went down last week, and then we do have both Andhra and Telangana coming into the program this year, the crop program. Company will participate in some of these and seek to expand its crop business. Coming to commercial lines, fire marine, even last year, we grew higher than industry. And it is a fact that we have been stepping up our presence in the corporate business segment. The Japanese and Korean segment is a smaller segment out of the overall commercial business, but that's a segment where the business is quite stable and sustainable. So we have secured higher reinsurance capacities during the year, and we should be stepping up for growth even in the Indian commercial business. This is also in a bid to diversify and de-risk the concentration in the motor segment. I talked about as to how the motor composition has shrunk to about just around 65%. Our immediate term goal would be to move it down to about 60%. Having said that, we will continue to grow in motor. It's only the composition part that I talked about. In motor, our focus will continue to be in the cars and in the commercial vehicle segment. In Q4, we did grow higher than the industry in motor. We have in H2 of last year balanced our expenses of management of control with the growth, and we have been able to fairly ensure that we are able to grow while maintaining the expenses of management in control. A 3-point reduction, 3.15% reduction in expense of management is quite substantive given the size of the company. So to summarize, yes, the growth will also come from health, where the proportion of both indemnity and benefit, the overall volumes is poised. So overall, if you are to broadly look at, we should be looking at least a 1.35x of industry growth for next year, and with at least a 1% shift away from motor into the other lines.
Perfect, sir. Perfect. So basically, can I safely say that a crop which is 465 crores or 470 odd crores can potentially become, given you are okay to take exposure to 3 new states, maybe if you continue to hold the states in Maharashtra, districts in Maharashtra, then is it safe to assume that you will be around 600-700 crores in the current year?
See, the Maharashtra will continue for 2 more years, 24-25 and 25-26. So if there is no further insurance penetration, farmer coverage, area under coverage, one can reasonably assume that the 465 crores would be intact. Right. But in terms of proportion, given the growth in other lines, I would tend to think that crop would come down to about 5% of the overall volumes.
Okay, got it, sir. And my next question is on EOM. Naturally, that you partially answered that question, but just wanted to understand that whether it will be largely product mix change which will drive the EOM improvement, or you believe there are internal operating efficiencies which can still play out. Means if you want to give broader breakup, how much operating efficiencies and how much product mix can contribute to that EOM improvement roadmap?
Yeah, obviously, EOM reduction is a combination of the product mix, the channel mix, sometimes even geography mix, and of course the efficiencies that the scale of business can bring in. So naturally, we are seeing the benefits of scale. So even from where we were a couple of years back to the current level of 7,500 crores, we have seen the benefits of scale come with respect to pure operating expenses. We expect that to continue. On the product mix, definitely yes. So a higher level of commercial business can mean and contribute to a reduction of EOM as we go along. So that is something that we would want to look at.
Got it, sir. And the third question which I had is that your core is 109.9, your loss ratio is 73.7. So from a data keeping point of view, if CAT events were not there, or India was limited to 1 CAT event, which is generally the case, instead of 3, then this core, how much you expect in a normalized thing to play out? And then also you spoke about in the initial remarks that reinsurance commissions also had a negative impact on the core in the current year. So if things normalize, especially in 24, this 109.9 combined improvement in loss ratio and along with the EOM roadmap what you have, what is a more realistic number what we can expect it to be in 25 and 26, sir?
Yeah. So I did say that the CAT events, even without the impact of the reinsurance commission reduction that it had, was about 108.8. So that is the combined ratio for the year ended March 24. I do agree that some CAT event of some order and scale will happen through the year, even in the coming year. One can reasonably expect that. But with the EOM reduction and the other efficiencies that can come about, the business team is fairly confident that we should be looking at least 1 to 1.5% reduction in combined ratio from the current level. And that I mean, if it is 109.9, one can expect about 1.5% at least a reduction from that level.
And can we expect the similar trend to continue in 26, 20, means from 2 years point of view, sir?
See, the insurance industry is fast changing, so you have new regulations coming in. So one has to really understand the effect of the regulations and the changes that come about. Yeah. So one can reasonably expect that given our track record, we will pursue the path of both growth and efficiency when it comes to operating, while staying conservative in our motor third-party reserving. So we do know that our reserving levels are conservative as compared to other players in the market, and which has an effect on combined ratio, given our motor dominance and given the effect of at least, actually, if one were to take it to market levels, our combined ratio would probably be 3 to 4% lower. Right. But we want to stay prudent and conservative when it comes to motor third party reserve.
Got it, sir. And last one, on health insurance, can you give the breakup or contribution of benefit-based, long-term benefit-based to the total premium?
See, our long-term business in relation to total business still stays at about 8.8% of the total top line, and this would include the health benefit, the personal accident, as well as the dwelling business that we write. Yeah. So we continue to absorb the costs upfront, which is also baked into the combined ratios that we report. One can say that the regulator is fairly considering the absorption of these costs over the life of the policy. So if that were to materialize, the industry is awaiting a master circular from the regulator on this. If that materializes, you will find a substantive jump in the profitability per se, the reported profits, even from the current year. And when it comes to the health indemnity benefit, we are excluding personal accident. We have about 44% of the business coming in from the benefit segments, with the balance coming in from the indemnity.
Got it, sir. That's it from my side. Thank you very much.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Devansh Negotia from Safe Enterprise. Please go ahead.
Yeah, so thanks for the opportunity. Sir, in case of crop insurance, I think we have reported a loss of almost 20-25 crores for this quarter. So if you look at outlook in terms of its revenue contribution and what should be PBT contribution for FY25, and we mentioned that we have some stop loss over here and we are reinsuring it, and I think we have some visibility of 5% underwriting profit. So if you can just re-clarify on that as well, so that will be helpful.
Janu, can you take that?
Yeah. Crop insurance for the financial year 23-24, we did a premium of 465 crores. The loss ratio has been estimated at 100%. You all know that the scheme itself is operating 80% to 110% corridor. So we are taking care of the 10% in the soil part of it. That is why it is, the estimated loss ratio has been around 100%. Naturally, if it is a 100% loss ratio, the underwriting loss is, the car will be much more than the 110. So this is an estimation. We need to, estimate the element of how the Rabi season will go off as a part of that. We expect that the loss ratios will come down from the 100% level when it finally, estimated from, finalized from the point of view of the final LR. The margins in crop is much lesser, as you all know that. Depending on, the last year it was a drought year. Going forward in 24-25, we can expect betterment in terms of that if the monsoons are good. These are all purely dependent on the monsoon. We are looking at, we went into that from the point of view of the two parts. One is the 80-110 corridor, which gives us a lesser level of shocks to us in terms of that. Secondly, we have also looked at from the point of view of the UOM, that we have been telling about that in the earlier quarters call also. So that is actually helping us from the point of view of fulfilling to the UOM limits. That is also the second part of the story. And we are looking at additional states, as Suri has said about that. That may also help us from the UOM perspective. So as far as the solvency is concerned, it has already been built into that. So there is no disallowance from the point of view of the recoverable from the crops point of view. That likely we have got every amount that is due from the Kharif season. This is from the crop point of view.
To add to what Venu has said, When it comes to the crop claims ratio provisioning, we have been conservative in providing at 100% of the earnings. And I can say now with confidence in the hindsight of almost 45 days into the next quarter that the actual results are turning out better and we could well possibly see some reversal of provisioning in the coming quarter.
Sir, but I think we did mention that over here we have a kind of reinsurance arrangement which gives us visibility of underwriting profits of I think around 5%. So I'm just trying to understand what has changed here because what you mentioned was that we were underwriting this business with an expected combined ratio of 105, and then the reinsurance arrangement allows us to at the end make a 5% underwriting profit. So I mean, has anything changed over there, or because when we started underwriting it, we had like a clear visibility on the profits over here. And another thing is that for FY24, the segment underwriting loss is 63 crores for crop based on our. So, can you just re-clarify on that number as well? And from underwriting profit, from claims to underwriting, there should not be much difference, right? Because this is just B2B and you just participate in a tender with no employee cost or distribution expense. So why is there a difference between claim ratio to flowing from claims to underwriting profit and loss?
Yeah, see, if there is an element of, if you even look at the last ratio from the crop side, it is 104.2 is the financial year 23-24. With the assumed loss ratio of 100%. The 4% is the additional actual cost that is triggering to that. You should understand the reinsurance protection from 100 to 110 cost is around 4% itself. Okay, that is one cost is a sunk cost. Secondly, there are additional expenditures in the crop, which is normally, though 30% is allowed in UAM, the crop has got its own expenses in the form of managing the, claims, as well as from the point of view of, enrollment on the collection side, premium procurement side. So all put together around 6.5% is the direct costs that are there. That is also part of our cost. So when you talk about the 5% margin, I don't remember where we have said about that, clearly. It all depends on, that's what we clearly said while writing the crop itself on two folds. We have gone into that mainly because of the 80-110 formula that the government has given. That gives rise to a level of, lower LR of 80%. Below that, anything that we need to give back to the government as premium. And more than 110% will be borne by the government in terms of the claims. So, it never be the 5%. 5% margin means we need to operate at 85% loss ratio. Then only it is possible. That all depends on the monsoon and various other factors which are beyond the control of insurers.
So to comply with EOM, then we will have to underwrite a business where profitability, historically hasn't been that great, which can impact our profits if we scale it up from here on. Any thoughts if you can share on that?
See, crop business is also subject to vagaries of nature. And one would recall that the Kharif season was beset with a very indifferent monsoon in July, August of last year, which also impacted the crop yields for the Kharif season. The Rabi season has turned out much better, bringing the balance to the overall loss ratio there. So one won't tend to broad brush saying that it is a loss-making business. But then the risks of the business, in as much as it's subject to vagaries of nature, is very much alive.
So just last question. What would be your guidance for FY25 and FY26 in terms of revenue growth and combined ratios and ROE?
I thought I answered that when Sanket asked that question in terms of what we would look for. Growth, yes, we would want to grow at least 1.3 to 1.35x industry growth, which certainly would take us much higher in terms of size. And likewise, from the current level, we would be looking for at least a 1.5% improvement in the combined ratio.
Okay. Thanks a lot, sir, for answering my question.
Thank you. Next question is from the line of Mahik from MK Global. Please go ahead.
Yeah, hi. Thank you so much for the opportunity. So, sir, in the previous question, you mentioned that you would like to focus on the CV and PV segments in the motor business. So, just wanted to know that among these segments, which segment would you like to grow at a faster rate? And secondly, how do you see your channel mix shaping up in FY25?
Channel mix, let me take the second part first. So we would definitely see our agency business grow stronger. The bank assurance business will, which also with the addition of the new banks that we had in the previous year, should help in the growth. The company is still in discussion with a couple of other banks, and any positive turnout there can mean a further growth in volumes. Besides the business growth from our own sister company, Chola Finance, I think that will also abet and contribute to our growth in the motor side, across products, and of course in the benefit business that we provide. So overall, I don't think growth is a challenge for us in the next year.
Okay, sir. And on the motor side, which segment would you like to grow faster?
See, we have been growing. If you see even the charts, we have been growing our proportion of cars. It's there in page 57, where you can see that the motor is now 65.9, and then within that, if one were to look at the composition of motor in page 56, you will find now that the cars and commercial vehicles are now almost getting equisized from 39.5 and 43.8 respectively. So you will see further growth in cars, particularly from the agency segment. The company gets roughly about 30% of its total motor premium from new vehicles, which has been fairly consistent. So that should also help in the growth. The company, however, would look at the two-wheeler segment a little cautiously and would clearly await the government signals and decision with respect to motor third-party premium reduction.
Okay, sir. Thanks a lot. Thanks a lot.
Thank you. A reminder to all participants, you may press star and 1 to ask question. Next question is from the line of Anand Bhavnani from White Oak Capital. Please go ahead.
Thank you for the both the businesses of the holdco are growing and expected to grow well. So from the capital needs perspective, how do you see from, let's say, 3-year perspective, would we as a company at the holdco level would have to raise capital to maintain our shareholding in both the businesses, or we would be comfortable the shareholding going down? How are you thinking about it? If you can comment a bit.
So as far as the Chola NBFC is concerned, I think the capital requirement will be far higher because of its growth appetite and the opportunity to grow. And in the last 2 fundraisers, Chola Financial Holding participated in the first one, and we could maintain the shareholding in the same ratio. The latest one, we did not participate, and there was a dilution. As far as Chola Insurance is concerned, I think both the partners are committed to support the need of the growth as far as their insurance growth is concerned. So we would be able to fund if there are any requirement on capital side.
Noted. So if I were to summarize, in Chola Investments, if our shareholding over the next few years due to more capital, if we were to go down, we are comfortable with that. And for insurance, we have enough capability to continue maintaining our shareholding. Is that the right summary?
Yes, fairly right, sir. Yeah.
Secondly, sir, from a value unlock perspective.
Mr. Bhavrani, we're not able to hear you.
Hello, is this better?
Yes, sir. Please go ahead.
Yeah, thank you. So from the value unlock perspective, just wondering how the board is thinking. I think you must be seized of the matter that a general insurance company coming for an IPO, they are not much different size. And when we look at the valuation.
Sorry, sir. I think your line is not. We can't hear you well.
My question is on value unlock. If I'm audible, the value unlock for the business, given that we are at a valuation which is less than the sum of the two holdings.
Yeah. We understand your question, and I think definitely we are aware, and we will look into opportunities to unlock the values at an appropriate time.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Atul Mehra from Motilal Oswal Management. Please go ahead.
Yeah, so just a follow-up on the previous question. So can a buyback be in terms of executed in order to unlock value in the interim that, like, obviously the listing will happen as and when there is a long-term plan around it, but from the cash flow that you have, can you execute a buyback so that the underlying value for minority is realized?
Yeah. So I think the board would consider all options and would take an appropriate action. And board is aware of the market, the fund requirement of both the businesses, and how the regulatory changes are evolving, and would take a call at an appropriate time.
Got it. So what is the current stance of the board on this matter? Like in the recently concluded meeting, it was discussed. What is the current stance of the board, and what are the various options that are available to unlock value?
Yeah, I think I'm sure you would appreciate that. I think we will be happier to discuss with you once a proper call is taken. Then it will be easier for us to come and present all the options, why we took the options, etc. So we will definitely do that at an appropriate time.
Sure. Thank you very much, and look forward to more clarification on this matter, maybe at an opportune time, maybe in the next conference call or ahead of it. So it will be really helpful if we have a proper communication from the board on this matter, so that as a minority we are very clear of what are the next steps to be in terms of follow to unlock value. So look forward to that, sir. Thank you very much.
Sure. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Ladies and gentlemen, as there are no further questions, on behalf of DAM Capital Advisors Limited, That concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.